Welcome to Engineering Management by Sherwin. In this video, we'll explore relevant costs, what they are, why they matter, and how they guide better business decisions. Decision-making is at the heart of business management. Relevant costs play a critical role because they focus only on the costs that truly matter to the decision at hand. In this lesson, we'll break down the concept and see how it applies in real scenarios. Relevant costs are those directly related to a specific decision. They differ between alternatives, are future-oriented, and have the power to influence the outcome. If a cost doesn't change based on your choice, it's not relevant to the decision. There are four main types of relevant costs to consider when making business decisions. First, differential costs. These are the differences in costs between two or more alternatives. If the cost changes depending on the option chosen, it's a differential cost. Second, opportunity costs. These represent the benefits you give up by choosing one option over another. For example, using a machine for one project means you lose the chance to use it for a potentially more profitable one. Third, sunk costs. These are costs that have already been incurred and cannot be recovered. Since they won't change regardless of the decision, they should be ignored in the analysis. And fourth, incremental costs. These are the additional costs that arise when choosing a specific alternative. For instance, accepting a special order might require extra labor or materials, which are incremental costs. By correctly identifying these cost types, managers can focus only on the numbers that truly affect the decision. Focusing on relevant costs is essential for effective decision-making in business. First, it enables cost savings by helping managers identify and eliminate unnecessary expenses tied to a decision. Second, it supports profit maximization. By considering only the costs that actually change between alternatives, businesses can choose the most financially beneficial option. Third, it improves resource allocation. Relevant cost analysis ensures that limited resources, like time, money, and labor, are used where they have the most impact. And finally, it leads to better informed decisions. By focusing on future-oriented and decision-specific costs, managers can avoid distractions from irrelevant figures, like sunk costs, that don't affect the outcome. In short, relevant cost analysis keeps decision-making focused, accurate, and aligned with financial goals. When applying relevant cost analysis, the decision criteria are straightforward. If the total relevant costs of producing a component in-house are less than the purchase price from a supplier, the company should make the component internally. On the other hand, if the total relevant costs of in-house production are greater than the supplier's price, the smarter choice is to buy the component. This simple comparison can be applied not only to make or buy decisions, but also to other scenarios like outsourcing services, selecting projects, or evaluating process changes. The key is to base the choice only on costs and revenues that change between the alternatives, ignoring anything that remains the same. Relevant costs are vital to sound decision-making. By focusing only on costs that truly matter, managers can make choices that improve profitability and efficiency. Remember, ignore sunk costs, focus on future impacts, and choose the option with the best financial outcome. Thanks for watching. This is Sherwin from Engineering Management. Don't forget to like, share, and subscribe for more lessons in managerial accounting and decision-making.